Welcome to Reverse Mortgage Radio, hosted by Legend's very own reverse mortgage professor, Bruce Simmons. You have so many options with a reverse mortgage, everyone has a different opinion, and the government keeps changing the rules. You need to hear from the first certified reverse mortgage professional in Colorado to specialize exclusively in reverse mortgages, one of few in the state with the letter CRMP after his name. Bruce has the specific training and education you need to understand what you're buying. Now, here's your host, Bruce Simmons.
Welcome back to another episode of Reverse Mortgage Radio. Thank you so much for joining me today. You're in for a treat because we have a special guest today that we're really looking forward to talking to. But before we get there, I do want to remind you, please feel free to call me anytime throughout this show with any questions about reverse mortgages. My name is Bruce Simmons, and my number is 303-467-7821. That's my direct line. You can reach me at any time at 303-467-7821 or visit me online at reversemortgageradio.net. Now, I do want to jump right into our special guest. Welcome back to the show, Brady.
Thanks, Bruce.
If you haven't listened to the show before, Brady's been a guest a few times on the show, Brady Mullin, and you and your brother have written a couple of books recently.
Yeah.
And we're here to talk about one, but tell us about both. Like, what's the other one we're not going to be talking about today?
That one's about home ownership in general. So that idea, for whatever reason, is kind of under attack from some of the what I call financial influencers, the people that are using social media to create these big audiences. Now, they're not licensed, they're not fiduciaries, there's no retribution if they give bad advice. They're just running interesting channels, and a lot of their information is correct, right? They're not. If everything they said was wrong, they wouldn't have much of a following. But they're also very compelling, and in a lot of cases, they're wrong. And one of the reasons they're wrong, and this is really common out in the world, is that the real estate world and the financial world, the industries that represent real estate, like lending and real estate agents and things like that, and the industry that represents financial services, they don't integrate very well. And the problem that my brother, who's a CPA, so my background's in financial planning, my brother's an accountant, and the reason we got passionate about this is everybody knows that the choices that you make about real estate have a massive financial impact, and yet they're not getting good financial information from their real estate professionals, usually, and they're not getting good real estate advice from their financial professionals, but it's obvious to all of us that those two things are very, very tightly coordinated or integrated, yeah, like they affect one another very, very greatly. So that was the passion behind writing these books, just because homeownership is so fundamentally important to a stable financial picture. So that's why we wrote that book. And then the book you want to talk about today about reverse mortgages, we call it The Financial Ugly Duckling.
Yeah, I like that name. That's
thank
good.
you.
Yeah.
I have to give my brother credit for that idea. That was his clever, like, hey, this is like the ugly duckling metaphor. But we think that reverse mortgages are one of the most misunderstood and incorrectly maligned financial tools I've ever seen. They're actually quite clever, quite innovative and interesting, and yet people look down their nose at them. But it's incorrect that they do so, because it's a very flexible and interesting financial tool.
Yeah, that brings us to the book itself, because you one of the things you talk about, you have a chapter in there called The Most Important Thing.
Yeah.
What is the most important thing? Let's start off with the good stuff.
Yeah, the most important thing is also, maybe the best way to think of this is it's misunderstanding this is probably the source of almost all the misconceptions about reverse mortgages. And the most important thing is that you have to look at the whole picture. You have to look at the whole, another way to say it is your net wealth concept. So here's a simple example. If you buy a house, let's say you buy a house for $500,000 and you get a $475,000 mortgage on it. Did you just create $475,000 worth of debt? The answer is, well, yes, you did. But you also now have a $500,000 asset on the other side of your balance sheet, and that's okay. In fact, that's actually great. You look at that over the long term, and that actually worked out well for you. So debt, now we're all very familiar with the destructive power of debt.
Yeah.
If you have a problem with debt and you can't stop spending money on credit cards and they're charging you 29% interest, that's like a raging forest fire out of control, and it will destroy. But also, there's $35 trillion worth of, that's a huge number, by the way. Like, our intuitions do not grasp how huge that number is. Just a fun exercise I like to use is 1 trillion seconds. Everybody listening, 1 trillion seconds is 32,000 years.
Serious?
Yeah, $1 trillion is an enormous number, and we kind of throw it around in the United States because of budgets and deficits. Like they reach that number in a well, we could talk about that another day, but like it's a huge number, and there's $35 trillion worth of wealth in people's residences in this country. That's a huge number. And what percentage of that do you think would be there without somebody using debt along the way to get that process started to own homes?
Yeah, very, very little.
Almost zero, right? Yeah. It probably rounds to zero. So debt clearly is also a very useful tool to help people get started and create wealth because it allows you to use capital to build wealth.
But where you hear so much of negativity about it because right now the government is at all-time high in record debt. Businesses have all-time high in record debt. Consumers have all-time high in record debt between credit cards and student loans, car loans, everything is, and those are starting to go into default too, some of those. So
I clearly do not want to be seen as somebody saying that debt is good. What I'm saying is debt is neither good nor bad. It's a thing, right? So if I'm using debt to buy a home instead of paying a landlord for the next 40 years, that's a good thing. If I'm using it to buy a pair of sneakers that I don't need and I'm going to pay 29% interest, that's a bad thing. Yeah. But it's not a good, the debt itself is not a good or a bad thing. It's just a tool. So where this comes up in the sense of a reverse mortgage, the most important thing that I'm talking about is that you have to look at both sides of the balance sheet.
That's it.
For example, let's say, so the example that I often use when I'm talking about this is, imagine a 75-year-old couple that wants to go on a vacation for their 50th wedding anniversary, and they want to invite their children and their grandchildren, and they don't want anybody to have any financial pressure to come, and they don't want anybody not coming for financial reasons, so they decide that they're going to foot the bill for this vacation. Now, just for round figures, let's call it $50,000. That might be extreme, but maybe not. Yeah, if you're going to get flights and cruise tickets, maybe that's normal. Yeah. But either way, let's just say the number's $50,000 because that's a number that we can easily do math on. Now, if they sell $50,000 worth of investments, how much smaller is their net worth today?
$50,000.
Exactly $50,000, right? And if this family could afford this, would anybody think less of them for spending the money on that kind of trip with their children and their grandchildren for a 50th wedding? Like, you're celebrating the creation of this big family that you've created over 50 years of marriage. Like, it's an awesome thing to spend, save. Like, who would look down their nose at that? That's a great idea.
You'd be jealous of them because they could do it.
Yeah,
this is
what an awesome thing to spend your investments on.
Yep.
As long as you can afford it, right? I'm not recommending people do that who can't afford it, but let's say it's affordable. No, nobody's looking down their nose at that. Now, as soon as they spend the money and go on that vacation, they're $50,000 less wealthy. No big deal, but you also have a bunch of Shutterfly books with memories, and they're on people's coffee tables when they go home, and you've got, like, that's a worthwhile thing for spending money. Now, if I, instead of selling my investments for $50,000, what if I put the $50,000 on a line of credit, which is what a reverse mortgage is fundamentally? Yeah. Often people don't understand that, but that's all it is. It's like a HELOC on steroids. So if you put the balance on a reverse mortgage instead, how much less wealthy are you that very day when you buy the tickets?
$50,000.
Yeah, it's the same thing. Your net worth hasn't changed at all. Now, fast forward 10 years. My investments 10 years from now, if I use my investments for the trip, my investments are $100,000 smaller than they would have been had I not gone on that trip, assuming that they would have doubled over 10 years. That's about 7% interest, 7.2. So my investments are $100,000 smaller. I am $100,000 less wealthy 10 years later if I sold my investments to pay for that trip. Uh-huh. And nobody's denying that, and nobody is claiming that wasn't money well spent when they went on the vacation. And by the way, that's what all money does all the time. If you and I go eat lunch and we each spent $20, that's $40 we won't have 10 years from now if we had invested it otherwise. But is anybody saying, hey, you should never go out to lunch with your friends?
No.
That's not reasonable, right?
That's right.
But the easy thing about it when we're selling the assets and using those instead, or just, spending money on something that isn't absolutely necessary, the reason that's easy emotionally is because we don't have to look at it. Right.
That's a great point. That's an interesting thing that you don't think of. It's like, you're spending this money, but you're not looking at the what could have been.
Yeah, because you're not forced to.
Yeah.
Right? There's no way that 10 years from now, I'm going to look back at the lunch that I had today with my friend Bruce that cost me $20 and think, man, that cost me $40 because 10 years ago I spent $20. There's no way I'm going to have to, I'm not even going to think about that.
That's right.
But had I put that cost, let's go back to the vacation analysis. If I put that $50,000 on the reverse mortgage, and let's say I never make a payment, because a reverse mortgage is a line of credit where you can do whatever you want with the balance as far as the payment is concerned. You can pay it down, you can pay interest only, or you can make no payment and let the charges accrue on the balance. That amount of flexibility, that's incredible. But what happens, and this is the dissonance that causes some emotional friction here, most people don't make a payment on the balance because they're thinking, I've got a better use for that money. I have something else I'd rather do with it. I'd rather save it, I'd rather invest it, or maybe I don't have the money and I don't want to make that payment. And if that's the case, you probably shouldn't go on the vacation if you don't have the money. But sometimes we're not talking vacations. This is just a fun story. It might have been a medical bill, right? It might have been necessary. But let's go back to the vacation because that's warm and fuzzy. If you spend that $50,000 on the line of credit, and let's say for the next 10 years you don't make a payment, so the charges just accrue on the balance and compound over 10 years, that $50,000 will become, if it accumulates at 7.2%, which is very reasonable, that's about where rates are right now anyways, if that accumulates, 10 years later, you will have a $100,000 balance on that line of credit. That's the part that kind of freaks people out.
Yeah.
Because when you look at that in isolation, that feels wrong. Oh my goodness, I owe $100,000 on this line of credit, and I only spent $50,000 10 years ago. This is out of control. This was such a bad thing. But what you're failing to realize is your investments that you did not sell are $100,000 larger than they would have been had you sold them. Your balance sheet doesn't care which asset you use. 10 years from now, if you go on that vacation today, 10 years from now, you will be $100,000 less wealthy. And by the way, that is inevitable, and you've been doing it your whole life. With every dollar you ever spend, it's some amount of money in the future that's more that you will not have. So it's not a math problem, it's an emotional problem.
That's a good point, because the math is math. It's what it is. It's how we interpret it, our feelings towards it.
Yes, and so if that's the case, a lot of people would ask, well, then what's the difference? Why not just sell the investments? And the answer to that is it's significantly more tax efficient to use the loan.
Yeah.
Which is why wealthy families have been using this strategy through traditional, lending or borrowing against their assets rather than selling. Because if you sell assets that have appreciated, you have to pay taxes on that, and they don't want to give up control or pay the taxes, so they borrow against it instead because they have heavy hitter financial people showing them and doing this for them, so they're less emotionally connected to it. But when you do that yourself, there's that emotionally misleading financial concept that's happening that's hard to look at. But fundamentally, without taxes, it's the same thing. When you consider the taxes, it's significantly more tax effective to use the line of credit instead.
That the way you word it just clarifies things so well, I think, and that's a nice thing about the book. Guys, I got to say that this book that Brady and his brother Dan wrote, it's a very well laid out and structured book, very intentionally, because you go through so many different ideas about the reverse mortgage from start to finish. I think, like, just thumbing through it in the beginning. Well, one thing I like about it too are the quotes that you have. You open up every chapter with the quotes. Like
that was fun.
The very first one, how the HECM works. That's chapter number 1, and he says, anyone who stops learning is old, whether at 20 or 80. Anyone who keeps learning stays young. The greatest thing in life is to keep your mind young, and that was Henry Ford.
Yeah.
And one thing that I thought was really apt, because it got me looking up quotes, I found this other quote. It says, it's what you learn after you know it all that counts.
I like that.
That's John Wooden, the UCLA basketball coach.
That's a good one. That's a good one. Maybe I should have used that one instead, because that applies to reverse mortgages.
Yeah, exactly.
One of the challenge we have with reverse mortgages in general in helping people understand how they work, the problem is they think they already know.
Yes, that's it.
If people knew they didn't know, they would be hungry for knowledge. They would want to know, hey, what's this tool that people are talking about? I want to know. But when people think they already know, they dismiss it before they even have a chance to learn that their preconceived notions about it are actually incorrect.
That's right. And that's the thing that drives me crazy. That's why I say the most dangerous myth about reverse mortgages is it's only for desperate people. Because what the people you recommended or talked about in that story, they obviously weren't desperate. And I've done a number of loans for people that have $1 million plus in their asset, their portfolio. And most of the people I do loans for are not desperate. But so many people have that in their mind. They know that this is only for desperate people. This is a last resort option, and you should only do it as a last resort because it's a negative thing.
Yeah, one of my favorite thoughts around that idea is, I got to credit Don Graves with this. It's a great quote. He says, how many people do you know that are 100% certain that they will have enough resources to live out their retirement no matter what happens?
Nobody.
Yeah, that has to round to zero.
Yeah.
Unless you're Bill Gates listening to this show, A, we would love a donation, Bill.
Yeah, there you
B, you can't certainty is too high of a bar. Mm-hmm. And if you understand the reverse mortgage for what it is, which is a line of credit where the credit limit itself increases every month for the life of the loan, which could be as long as you live there in that house, mm-hmm. right? That is an ace in the hole should something come down the pike that you're not prepared for, or maybe something comes down the pike and you really do have the wealth to cover it, but your investments are down at that time and it's not a good time to sell them. It gives you all sorts of flexibility. Here's another way of thinking of that. Imagine some big behemoth company, and since we were talking about Bill Gates, we'll use his, Microsoft, right?
Yep.
Do you think Microsoft has lines of credit set up with financial institutions all over the globe?
I'm sure they do.
Absolutely.
Yep.
And it's not because they don't have assets. That's silly. It's because lines of credit are incredibly useful. It gives you lots of flexibility. If nothing else, it gives you access to dollars that are predictable and there without having to have a bunch of money in the bank and forego the opportunity cost of not having that money invested.
Just like you were talking about with the $50,000, the opportunity cost of losing out on future investment.
Nobody is so wealthy that a line of credit isn't useful.
I did a loan for a retired financial advisor who has $7 million in his portfolio, $1.5 million home free and clear, and he did a reverse mortgage setting up just the line of credit, took no money out other than the closing cost, and he said this is his nuclear option.
Yeah.
Is exactly what you're talking about. Yep.
It's a line of credit that's increasing, that cannot be turned off, it cannot be frozen as long as you're in the home and paying your taxes on the home.
Yep.
It's an ace in the hole. Like, you cannot tell me that you will not need that unless you're worth gazillions of dollars. You just never know.
Exactly. So you are listening to Reverse Mortgage Radio. Thank you for tuning in. My name is Bruce Simmons. I'm the Reverse Mortgage Manager for American Liberty Mortgage in Denver. You can reach me directly with any questions about reverse mortgages at 303-467-7821. 303-467-7821. Also, visit me online at reversemortgageradio.net. We're talking with Brady Mullin, who is the author, along with his brother Dan, of a book called Reverse Mortgages, The Financial Ugly Duckling. And I do have a few copies left of these books that I would be glad to send to you for free. 100% free. All I need is your name and your address. So you need to give me a call, or you can actually put your information on my website, fill out the form on there saying you want more information, and say, hey, please send me the free book. Here's my name and my address, and I would be happy to send you the book for free. I've only got very limited copies, so if we run out, I'll let you know and send you a bill. No, we'll get it for you. We'll make sure, or you can get them on Amazon. Or do you have a website yourself?
We just recommend people go to Amazon and get it. One thing that I'll point out that's kind of fun is both the books that we wrote, one about home ownership, one about reverse mortgages, became bestsellers.
Really?
Yeah, and wow. I'm not saying that to be like, to puff up my chest and say, look at this. Well,
that's exactly what you're doing now, but I won't. But this is radio.
I'm miming
right?
my words here. But the reason I think that's important is because clearly there's a demand for people wanting to know how to integrate their residents into their financial planning process, because financial advisors generally don't do that. Mm-hmm. Some do. I've met some brilliant financial advisors, but for the most part, as a normal part of the practice in that industry, they kind of think of home equity as something that they don't really touch, which is kind of strange because it makes up like 2/3 of people's wealth nationally, right? That's not true of any particular household, but it's a huge asset that people own, and all the reverse mortgage does, it's a line of credit that you attach to the house that makes that value liquid all of a sudden.
Yep.
And that's really important from a financial planning perspective. Because if you want to spend some of the wealth that's sitting in your home, you cannot sell $10,000 worth of your house, right? You have to sell it or not sell it. Now, you could borrow again. You could do like a cash out refi, but then you're going to have a new payment to make every month. And there are scenarios where that's exactly what somebody should do. There's like, we could come up with scenarios where that's a better solution, or they could sell the house and downsize to capture some of that equity. And there are scenarios where that's what somebody should do. But if you want to access the wealth that's sitting in the equity of your home, That's what a reverse mortgage is built for. It makes the home equity the home that you're living in, it makes that a usable asset in the financial planning process. That's all it's for.
Yeah, and if you look at the history of how it was designed, like you said, it was a very brilliant concept. If you couldn't design something better than the FHA insured home equity conversion mortgage. Really, the way it's the whole concept of it, how they calculate how much money is available. And I make fun of it because it's kind of complicated for the average person. Say, okay, well, we've got these two different interest rates, and it's, but it makes a lot of sense because the one rate we use to calculate how much we can loan you is a long-term rate. So we're looking at the longer term because you're going to keep this loan over a long term. That's what it's designed for. But one thing I like about your book is the way it's structured. Like I said, you've got everything in its place, but you talk about the three different strategies for reverse mortgages: the need, lifestyle, and then the planning. And we've been talking about the planning concept, but can you touch on the others too a little bit?
Sure, and I got to give credit to Dan Holtquist for thinking of it this way, but basically what we're talking about is a continuum, right? On one end of the continuum is people who need access to the equity in their home because they don't have enough assets to retire fully, right? So I think of that like when you call it could be a foot doctor, right? Someone that you wouldn't normally associate with as emergencies, but you even call a foot doctor, and the thing that you're going to hear before you get a live person is, if this is an emergency, call 911. Yeah. That's what I think about on that end of the spectrum. There are people who are out of other assets, but they live in a home with equity, and they need access to that equity. And we help lots of people like that all the time with reverse mortgages. In fact, that probably makes up the majority of the people that have been using these, mostly because they've been forced to learn to understand how they work because they've run out of other assets. So that's created a little bit of a problem in the industry because people associate reverse mortgages with somebody in that economic condition. Yeah. It isn't the reverse mortgage that makes it that way. It's that they've run out of all the other options, and then they've turned to this because they didn't know where else to go. And I will say, thank goodness for that. If my parents were in that situation and they needed access to the equity in their house so that they could pay for their full prescriptions and they could go out once a month with their friends or whatever, am I going to whine about getting a little bit less of an inheritance if I inherit a $800,000 house that has a $200,000 balance on it because they needed to use some of that equity? Am I going to whine about that? I better not. They didn't raise a very good kid if I did. Exactly.
So many people ask me, they say, well, you must get some pushback from the heirs for this. I say, no. Most of the time, adult children are doing the research for a reverse mortgage for their parents.
Yeah, that happens all the time.
Yep. So yeah. And that is unfortunate, but that's the way the program was sold for so many years, that this is to help people who really need the money. But it's always had these other planning ideas, but we've just never consolidated them into one simple way to look at it for wealthier people. I'll never forget the couple that I did a loan for years ago, back when I worked for the Evil Empire. These people were embarrassed because they had some medical things, and they ended up in some credit card debt and a car repair things, and they ended up having to buy a new car. And they were embarrassed because they would go to church and people would ask them, well, you want to go out for lunch after church or whatever? And they kept having to turn them down because they couldn't afford it. And they'd make up stories, oh, we're busy or this or that. And they just really wanted to be able to go out to brunch after church with their friends, and we were able to do a reverse mortgage for them, pay off their little mortgage that they had because they didn't know very much at the time. We gave them money to pay off their debt, and also a monthly stipend, basically a monthly payment every month. So it was a fantastic solution for them, and just the weight, you can see them at the closing, just the weight just lifted off their shoulders, and they were just so happy about that. And so they weren't somebody that was really, I wouldn't say terribly in need, but they were the people that really, really benefited from it.
Yeah. So if that spectrum that we're talking about, they probably weren't all the way at one end, but there's stuff in the middle, and there's we talk about that as like a lifestyle need. People who just want to. I think about people who have established children who don't need an inheritance. Yeah. If you could check a couple of extra items off your bucket list by using the equity in your home,
why not?
Yeah, is there any reason not to do that? I can't think of a real one.
No, No, not at all. Now, one of the chapters that you have in your book is about cautions. It says, you're spending your equity. You remind people of that, and you have a warning, I guess. For one of those is a warning about the temptation to spend frivolously.
Yeah, that's a common thing with reverse mortgages. Often, again, I think that's associated with the fact that a lot of times people who consider these are people who have run out of other options. And in many cases, those are people that just don't have the financial discipline. And sometimes if you give somebody in that condition access to $300,000 of tax-free cash, which is what a reverse mortgage can do, you can imagine scenarios where that might go poorly for somebody. They might spend through that too quickly. So what I try to encourage people to do is spend this as carefully as you would any other form of wealth that you spent a lifetime building up, because guess what? That's exactly what it is.
Yeah,
right.
exactly.
Your equity in your home is something you've spent a very long time building up. Do not spend it frivolously. Put a plan in place. Mm-hmm. Use that money and it doesn't have to just be for things that aren't frivolous. Like, it's okay to spend money and to have some extravagances in life. Mm-hmm. In fact, what's life without a little bit of extravagance, right? I want to go on trips. I want to do things with my family. But make sure that you have a plan so that you don't run out of that money before you run out of time.
That's right. I remember doing a loan for a lady that was on a couple of bowling leagues, and that was how she enjoyed her time. Bowling.
Yeah, would anybody want to take that away from her so that her kids will get a larger portion of the equity of the house?
Exactly.
That doesn't make any sense.
No, not at all. Also, too, one thing, one of the cautions that you had was waiting too long. How could somebody wait too long to get a reverse mortgage?
Ooh, we could go into a bunch of the math here, but the bottom line is the longer you wait, the more it will cost and the less you will get.
Well, wait a minute. The older you are, the more money you get.
That's true, but because it's a growing line of credit, I mean, you know this. I know you're like preparing me or preparing the audience to hear this. Yes, the older you are, the higher percentage of the home value you will get assigned for the beginning, for the starting amount for the line of credit. But once you put it in place, it starts growing from there. And historically speaking, you're much better off starting early and letting it grow than by waiting to age up. And we could go down a rabbit hole on this, but in a few scenarios where real estate appreciation or interest rates move in such a way where you actually would get more by waiting, you can always refinance into that higher line of credit, and the costs are significantly less because you don't have to pay the insurance policy associated with HECMs a second time.
That's a good point. Because, it's funny because, and I didn't get a chance to talk to her, but there's a real estate agent in my Toastmasters club. She's retiring, and she said, we were talking with our financial advisor, and he suggested that we might want to look into a reverse mortgage here in the future. And she's probably 65 or something. And I was like, oh, she's like, keep that in mind, and don't retire on me. She told me, I said, I still have 6 or 7 years or whatever. And she said, okay, well, that should be about right. And I didn't get a chance to really talk to her to explain, you might be better off doing it now, but she is on my list to call because I didn't just everything going on. I'm the president of my club, and we had a lot going on.
Yeah, the cost of the reverse mortgage is relative to the value of the home, so the later you do it, the more it's going to cost, and
that's true,
the smaller it will be.
That's a good point. Well, I really appreciate you being here, Brady. His book is Reverse Mortgages, The Financial Ugly Duckling, which we know that's the way they're treated. They're the ugly duckling of the finance world and mortgage world, both, really.
Yeah.
So we do have free copies of this. If somebody wanted to call you,
yeah, sure. They can call me or they can reach me through you. I mean,
okay,
I'm more than happy to chat with people about it. I do a lot of presentations to financial advisors, accountants, realtors. That's kind of what I spend a lot of my time doing, is helping them understand how to integrate this into the financial picture.
But if you want a free copy, contact me at 303-467-7821. This is a physical book. I'll mail it to you, 303-467-7821, or visit me online at reversemortgageradio.net. reversemortgageradio.net. Thank you so much, Brady, for being here today, and thank you for listening. I look forward to talking to you in the future. Thanks.
Always appreciate it, Bruce. Thank you.
Call Bruce Simmons today. Ask about his free Colorado Consumer Guide, 303-467-7821, or reversemortgageradio.net. Bruce will come to you anywhere across the Front Range to make sure you understand how reverse mortgages work. Regulated by DORA, NMLS number 409914. American Liberty Mortgage is an equal housing lender.